Let's give you the markets update now. Local trade set for another tough start with red screens from Asia after Wall Street ended largely lower overnight. Investors still digesting the International Monetary Fund cutting its global growth forecast for the year 2023. Jimmy Moyaha is independent markets analyst, joining us now for an update on how the JSE is performing in early trade. Top of the morning to you, sir. Let's talk about the volatility expected on the local front. Talk us through the factors influencing trade there.
Morning, Mr. Ngambi. Morning to our viewers. We've got a couple of things influencing overall trade. I mean, as you rightly mentioned, the IMF outlook that came out yesterday, and the concerns from the IMF are concerns that are shared globally. We know that we're still experiencing some geopolitical tensions off the back of the Russia-Ukraine war that's ongoing now there as well for about 8 months. We know that China's still battling with COVID-19 on their part, and we're seeing that overall risk sentiment within the market perspective is very risk-off at the moment. We're seeing dollar strength is back in the fold. The rand is back above 18 rand to the dollar and holding steadily above that. We're also seeing that oil prices are being affected slightly by the outlook and the expectations of what we can expect to see in 2023. But we do know that, of course, from an OPEC plus state, that they will do whatever they can to maintain oil prices at a suitable level for them. But overall, the sentiment at the moment is still very unnerving for equity markets and very and sort of anti-risk at the moment and risk off in general.
Well, let's pick up on the IMF. You've already mentioned the cut to global growth that they are forecasting. We're looking at China. There's a slowdown there economically. Ukraine, that war between that country and Russia. Things do not seem to be looking up on the global front. How is that likely to affect the economic performance globally?
Well, those are reasons that the IMF outlined yesterday when they did deliver their press conference at around 3 o'clock yesterday afternoon. They spoke very detailed about those sorts of concerns. But in addition to all of that, I mean, they alluded to a couple of things, saying about 30% of the world is going to experience a technical recession where 2 consecutive quarters of negative GDP growth are experienced around the world. So countries around the world are forecast to have that slowdown. They've also, I mean, outlined that this might be for some countries the worst year yet that they might see. We know that COVID, in their eyes, COVID sort of peaked around 2020, 2021, and we saw very low levels of demand back then, and they're anticipating that we're going to see those low levels of demand return once again. I mean, global forecasts have been downgraded to about 2.7% from about 2.9% earlier in July for next year, and we know that the US and China have both been downgraded for next year as well. We know that those are the 2 leading economies in the world. The US downgraded, I think, from about 1.6% to 1% growth over 2023, whereas China has been downgraded to a modest 4.4%. Now, for China, for the rest of the world, that seems like a significant number. But if you remember, 2021, China's growth was at about 8.1%. So 4.4% for them is extremely modest compared to what we've seen coming out of the Chinese space in recent times. So the overall sentiment from the IMF is that the concerns that are hampering growth and the concerns that are around things like the increased economic cost of living, the increased inflationary pressures on consumers are going to be things that are going to be driving factors for 2023, and they're going to be adverse factors where it comes to global economic growth.
Let's touch on commodities. Oil prices specifically, they've slipped as the dollar reaches a 24-year high on inflation worries. Help us make sense of those developments.
Certainly. I mean, we saw the oil prices slip about 1% yesterday, but we do know that, again, this is largely unexpected, unsurprising, given that we are experiencing that slowdown from China's side and from a demand perspective. We know that China is the largest importer of oil globally, and if they're sort of starting to slow down on their perspective in terms of what they're anticipating to happen, we're going to see that have a knock-on effect around the world. We're seeing that inventories around the world from an oil perspective, both U.S. oil and crude oil are increased, which speaks to the fact that supply levels are elevated, and we have seen OPEC come out to say that they're going to cut supplies by some 2 million barrels per day. I mean, obviously, analyst estimates at this stage are saying that that is not going to have a significant effect at this stage because we noted the oversupply already, and we're expecting a cut, and so that was largely being priced in. But we know that OPEC is not above having another price cut to maintain the price levels at levels that are suitable for them. We know that they don't want it to sort of dip below 90 towards that $80 a barrel mark. We know that they've preferred that they want to see oil prices at $100 a barrel. There's obviously those ongoing tensions from the Russia-Ukraine war and the increased sanctions that are coming into place. We know there's a fresh round of sanctions coming into place from Europe and the EU region countries that are going to affect oil at certain prices and transporting that oil through non-EU countries. So we know that the oil price is going to experience some level of volatility in the coming weeks and in the next month or two. But OPEC is very committed towards maintaining a price at a level that is suitable for them. And if they have to introduce further price cuts, we know that they won't hesitate to do that to maintain the price levels above the $90 mark.
Let's conclude the conversation with Zeda Investments posting its results for the 6 months, which ended on the 31st of August. And, wait for it, a special dividend declaration. How are their numbers looking?
So Zeda actually warned us last week, saying that their net asset value per share and headline earnings per share are going to be significantly lower when they release the results. We know that they've got a results presentation at 10 o'clock, but in a nutshell, they sold off a couple of assets. They unbundled that COP Agri holding, if you remember correctly. They also sold off their AgriVision Africa business as well. So the unbundlings and the realizations of those transactions, a lot of that in May, I believe, was paid over as a special dividend to their shareholders as well. And they've said from their perspective that they're going to continue on this trajectory of sort of wealth creation for their investors, saying that while their share price in 2019 was sitting at around 4 Rand a share, it's sitting at around 1 Rand 90 now at the moment. They're saying that they've paid out since then about 4 Rand 50 in value to shareholders by way of that special dividend in May and this recent special dividend announced now in these interim results. Obviously, the results are unaudited, and we'll have to see when the results presentation comes out if there's any surprises there. But they've said that they're continuing on their stability path and their outlook towards sort of unlocking the value that they have within their remaining assets. I think what we want to see from Zeda is what they could potentially be looking at from an acquisition and a growth perspective going forward, rather than what they have in terms of remaining assets. But we know that this results presentation, as I mentioned, is coming up in a little short while, and we are very much in line with what we were told by Zeda last week in the trading statement they released before these results.
Jimmy Moyaha, an independent markets analyst, thank you very much for that markets update.